In December 1989, Japan stood at the peak of human financial achievement. The Nikkei index touched 38,915. Real estate in Tokyo's Imperial Palace grounds was theoretically worth more than all the land in California. Golf club memberships sold for millions. Japanese corporations were buying Rockefeller Center and Columbia Pictures, like Americans buy coffee. The book, The Japan That Can Say No, topped bestseller lists, declaring Japan's economic supremacy permanent. Everyone knew, absolutely knew, that Japanese asset prices would rise forever. Then came 1990. The Bank of Japan raised rates from 2.5% to 6%. The Nikkei lost 60% in 2 years. Land prices began a decline that would last 3 decades. What followed wasn't just a recession. It was economic purgatory, 30 years of stagnation, a generation lost to deflation. The world's second-largest economy reduced to a cautionary tale. Now look at America in 2025. The Shiller-Cape ratio hovering between 35 and 37. Federal debt at 125% of GDP. Quantitative easing that makes Japan's bubble look conservative. Tech stocks priced for infinite growth. And everywhere, the same psychological marker that preceded Japan's collapse. Absolute certainty that this time is different. The story begins not in Tokyo, but in New York. September 1985, the Plaza Hotel. Finance ministers from 5 nations gathered to solve America's trade deficit. The dollar was too strong, killing U.S. manufacturing. The solution seemed simple: force the yen up, force the dollar down. Within 18 months, the yen appreciated 46% against the dollar. Japanese exports crashed. GDP growth halted in the first half of 1986. The Bank of Japan faced a choice: accept recession or flood the system with money. They chose the flood. Interest rates dropped from 5% to 2.5%. Money became essentially free. But this wasn't random policy. It was institutional panic dressed as economic management. The BOJ had to offset the currency shock somehow. They just didn't realize they were replacing one crisis with another. The excess liquidity created by low rates and current account surpluses had to go somewhere. It went into stocks. It went into land. Most importantly, it went into the Japanese psyche. Because when prices double and triple in a few years, when everyone around you is getting rich, when the government itself encourages speculation, you stop asking if it's real. You start believing it's destiny. By 1985, the Nikkei sat around 10,000. By 1989, it hit 38,915. Land prices followed the same trajectory. Financial deregulation in the mid-1980s made it worse. Major banks lost their best corporate clients to securitization. To maintain profits, they had to lend to riskier borrowers, real estate developers, speculators, anyone who wanted leverage to buy assets that were already overpriced. The entire banking system became dependent on one assumption: real estate prices never decline. Banks would lend against land. Borrowers would use that money to buy more land, driving prices higher, creating more collateral for more loans. It was a perpetual motion machine powered by collective delusion. The finance ministry saw the speculation. They knew it was unsustainable. But stopping it meant triggering the recession they'd tried to avoid after the Plaza Accord. No politician wanted responsibility for ending the party. So they let it run, promising to deal with consequences later. What nobody understood was how the Plaza Accord had fundamentally broken Japan's economic model. For decades, Japan had grown through exports, competitive manufacturing, and careful currency management. The forced yen appreciation destroyed this framework overnight. Companies that had thrived on exports suddenly faced extinction. The government's response, monetary stimulus, was like giving morphine to a patient with broken bones. It masked the pain but didn't fix the structure. The international context made everything worse. While Japan struggled with currency appreciation, competitors like South Korea and Taiwan gained advantage. Markets Japan had dominated shifted to cheaper producers. The temporary fix of cheap money created permanent loss of competitive position. By the time anyone realized this, speculation had replaced production as the economy's engine. By 1989, Japan wasn't just economically successful, it was economically invincible. This wasn't hidden confidence, it was published doctrine. Books celebrating Japanese superiority flooded the market. The most famous, The Japan That Can Say No, argued that Japan no longer needed to defer to Western powers. They hadn't just learned capitalism, they'd perfected it. Japanese buying sprees became legendary. Mitsubishi paid $846 million for Rockefeller Center. Sony bought Columbia Pictures for $3.4 billion. These weren't investments, they were victory laps. Proof that Japan had evolved beyond the boom-bust cycles that plagued lesser economies. The euphoria was universal. In January 1990, just days after the market peaked, 50 economists and strategists surveyed by Japanese media predicted another 15% rise in the Nikkei. Not one suggested decline. These weren't amateurs, they were Japan's brightest financial minds, all seeing the same thing, permanent prosperity. Corporate behavior reflected this certainty. Manufacturing companies became trading houses. Everyone played the markets. Companies borrowed not for operations, but for speculation, creating special vehicles to trade stocks and real estate. When your industrial firm makes more from land appreciation than from making products, something fundamental has broken. But nobody cared because everybody was rich. Families took 100-year mortgages, expecting their grandchildren to pay them off. This wasn't seen as burden, but as wisdom. Land was hereditary wealth. Debt was just the price of entry into eternal prosperity. The government reinforced the delusion. Officials spoke of Japan's unique economic model, lifetime employment, patient capital, government guidance. They'd discovered something Western economists couldn't understand. Market forces were for other countries. Japan had transcended. The cultural dimension amplified everything. In Japanese society, consensus matters. When everyone agrees prices will rise, disagreement becomes not just wrong, but antisocial. The few economists who warned of bubbles were dismissed as unpatriotic. Banks that suggested caution lost customers. The social pressure to participate and believe was overwhelming. Media played a crucial role in the hysteria. Television shows featured ordinary people who'd become millionaires through real estate. Newspapers ran daily stories of new price records. Financial magazines explained how to leverage your home for stock investments. The message was unanimous. Only fools weren't getting rich. This wasn't journalism, it was propaganda for a pyramid scheme nobody recognized as such. The boom ended December 25, 1989, when the BOJ raised rates. By August 1990, they'd hit 6%. The Nikkei dropped 7% in the first week of January. Officials called it healthy correction. By March, down 20%. They called it temporary adjustment. By October, down 40%. By mid-1992, down 60%. They stopped calling it anything. But here's what made Japan's crisis unique: the cover-up. The finance ministry initially thought only speculators would suffer. They blamed greedy individuals for the bubble, avoiding responsibility for systemic failure. When loan defaults spread beyond speculators, the strategy shifted to concealment. For 8 years, Japan pretended the crisis wasn't happening. Banks were allowed to carry bad loans at face value. Regulators pretended not to notice. The finance ministry insisted fundamentals were strong. Banks spent years camouflaging their portfolios of bad loans, as economist Edward Lincoln noted. The fear of appearing disadvantageous paralyzed honest assessment. This wasn't oversight, it was coordinated denial. Policymakers colluded with banks to hide the magnitude of non-performing loans. When they finally acknowledged reality in 1998, NPLs totaled 100 trillion yen. The economy had already entered what would become the lost decades. The term zombie banks entered the global vocabulary. Institutions technically insolvent, but kept alive through regulatory forbearance and subsidized lending. These zombies created allocative distortion, capital flowing to failed companies instead of dynamic ones. The productive economy starved while the dead were fed. Despite cutting rates to zero and massive fiscal stimulus creating the largest deficit among industrial nations, growth averaged just 1.1% after 1990. The Japanese business model was paralyzed by three excesses: excess equipment, excess employment, excess debt. Every solution created new problems. Every delay made recovery harder. The human cost of denial was staggering. Every year of pretense meant thousands of businesses operating without real purpose, millions of workers in unproductive jobs, billions of yen wasted on life support for corporate corpses. The opportunity cost, what Japan could have built with those resources, was incalculable. An entire decade of potential innovation, growth, and prosperity sacrificed to maintain the fiction that nothing was wrong. The accounting tricks used to hide reality became increasingly desperate. Banks would lend more money to bankrupt borrowers so they could pay interest on previous loans, making the loans appear current. Real estate companies would sell properties to subsidiaries at inflated prices to avoid marking down values. The entire financial system became a theater production where everyone knew the props were fake but agreed to pretend otherwise. The economic consequences were devastating, but the psychological damage was worse. An entire generation watched their savings evaporate. Their response wasn't to take new risks, but to take no risks at all. Savings rates soared. Consumption collapsed. Deflation became permanent. The promised middle-class society saw increasing income polarization. Lifetime employment ended. Youth unemployment soared. The social contract that defined post-war Japan, work hard, be patient, prosper, dissolved overnight. Marriage rates collapsed. Birth rates plummeted. Young people, seeing no future, stopped trying to build one. They became hikikomori, withdrawing from society entirely, or freeders, drifting between part-time jobs. A society that had prized collective effort and shared success fractured into isolation and individual survival. Companies that had borrowed to grow now borrowed to survive. Investment disappeared. Innovation stagnated. The corporations that had conquered global markets retreated home. Sony lost to Apple. Sharp nearly went bankrupt. Toshiba's nuclear division collapsed. The masters of technology became also-rans. The phrase "lost decade" became lost decades. Each year, officials promised recovery was imminent. Each year, it wasn't. Meanwhile, China rose. Silicon Valley created the internet economy. The nation that was supposed to own the 21st century became its museum piece. What made it worse was that everyone else moved on. While Japan stagnated, the world accelerated. The gap between what Japan was and what it could have been widened every year. The psychic scar of watching your nation fall behind while pretending everything was fine created a permanent sense of caution that infected every decision. The cultural trauma went deeper than economics. Japan had defined itself through rapid growth, technological leadership, and collective achievement. When these disappeared, so did national identity. The confidence that had powered the post-war miracle transformed into paralysis. Risk-taking, once celebrated, became taboo. Innovation, once natural, became impossible. The nation that had rebuilt from atomic destruction couldn't rebuild from financial destruction. Even successful Japanese companies adopted defensive strategies. Instead of developing new products, they refined existing ones. Instead of expanding globally, they focused on the domestic market. Instead of taking risks, they accumulated cash. By 2020, Japanese corporations held more cash relative to GDP than any other developed nation. They had money, but no courage to use it. The bubble's psychological damage lasted far longer than its financial damage. Now, examine America in 2025. The Shiller-Cape ratio between 34.78 and 37.71. Historical average, 17. The last times it approached these levels? 1929 and 2000. Both ended badly. But everyone knows it's different this time. America has the Federal Reserve, America has technology. America has innovation that Japan never possessed. These are the exact delusions Japan had about their unique economic model. Since 2008, the Fed has kept rates near zero for most of 15 years. Quantitative easing injected trillions into the system, just like Japan's post-Plaza Accord liquidity flood. But America did it intentionally, calling it sophisticated policy. That money went somewhere. Into tech stocks trading at astronomical valuations, into real estate priced beyond historical norms, into cryptocurrency, SPACs, NFTs, anything promising returns in a zero-rate world. The speculation isn't hidden. It's celebrated on social media, in trading apps, on financial news. Federal debt stands at 125% of GDP. Japan entered its bubble with relatively strong fiscal health. America enters with massive debt overhang. Japan could afford decades of stimulus. America can't. When this bubble bursts, there's no fiscal space for rescue. Corporate behavior mirrors 1980s Japan. Companies borrow not for investment, but for buybacks. Venture capitalists, research shows, display decision-making demonstrably biased by overconfidence. The same overconfidence that led Japanese banks to lend to anyone with land as collateral. The psychological parallel is perfect. American exceptionalism mirrors Japanese uniqueness. Faith in technology mirrors faith in manufacturing. The Fed backstop mirrors Ministry of Finance guarantees. Both nations convinced themselves that rules don't apply to them. But America adds new elements to the pattern. Social media amplifies herd behavior. Commission-free trading democratizes speculation. Cryptocurrency creates entirely new bubble assets. The tools are different, but the psychology is identical. Everyone believes they're getting rich. Everyone fears missing out. Everyone knows it will continue forever. The household debt situation adds another layer of risk. American households owe 68 to 69% of GDP, similar to Japan's pre-crash levels. But unlike Japan, where families had significant savings, Americans live paycheck to paycheck. When asset prices fall, there's no cushion. The margin for error is zero. One shock could trigger cascading defaults that make Japan's crisis look manageable. The Federal Reserve has become trapped by its own success. Every market dip triggers demands for intervention. Every intervention creates moral hazard. The Fed cannot allow significant decline without political crisis. They cannot keep inflating without economic crisis. This is exactly where the Bank of Japan found itself. But America's trap is worse. Japan's error was denial and delay, the slow burn. America chose maximum aggression, rapid cuts, massive QE, unlimited support. This averted depression, but created different problems. Quantitative easing exacerbated wealth and consumption inequality. Assets inflated, benefiting the wealthy. Wages stagnated, punishing workers. The policies meant to stabilize the economy transferred wealth upward, compounding social tension. The Fed's aggressive policies blurred lines between monetary and fiscal policy, contributing to politicization of the Fed itself. The public now expects central bank intervention for any decline. This expectation, moral hazard defined, means the Fed is trapped, fail to intervene, risk crash. Intervene, enable more speculation. Modern trading platforms democratize speculation. Meme stocks, driven by fear of missing out and cult-like fascination, create self-fulfilling rallies indistinguishable from 1980s Japan's golf membership mania. But when this crashes, millions of retail investors suffer. Not just wealthy speculators. The political pressure for bailouts will be immense. The belief that innovation makes America immune, that Silicon Valley and artificial intelligence trump economic gravity, is the same complacency that blinded Japanese policymakers. The nescience that prevented Japan from seeing their bubble is present today, just with different vocabulary. The institutional capture is complete. Banks know they're too big to fail. Corporations know the Fed will support markets. Politicians know voters demand rising assets. Everyone has incentives to continue. Nobody has incentives to stop. The same trap that paralyzed Japan's response has already paralyzed America's prevention. What's different is the speed of transmission. Japan's bubble took years to build and years to burst. America's bubbles now form and pop in months. The GameStop saga, the SPAC boom and bust, the crypto cycle. Each a mini bubble showing how quickly speculation can spiral. When the main bubble bursts, the velocity of collapse could be unprecedented. Digital trading, algorithmic selling, and global interconnection mean a crash that took Japan months could happen in days. History doesn't repeat, but it rhymes with mathematical precision. The pattern is clear. Geopolitical pressure creates policy response. Policy response creates excess liquidity. Excess liquidity creates asset bubbles. Asset bubbles create psychological certainty. Psychological certainty creates institutional blindness. Institutional blindness creates delayed response. Delayed response creates permanent damage. Japan followed this pattern perfectly. America is in stage 5, psychological certainty. The conviction that it can't happen here, the title of Sinclair Lewis's novel about political delusion, defines current thinking. But patterns don't care about national myths. The differences make America's situation potentially worse. Japan's bubble was concentrated in real estate and stocks. America's includes everything: stocks, bonds, real estate, private equity, cryptocurrency. Japan's banks were the primary speculators. America's everyone speculates: institutions, corporations, individuals. Japan could implement zero rates and QE as new tools. America has already exhausted these options. Japan had demographic tailwinds before the crash. America faces demographic headwinds. Japan was a creditor nation. America is history's largest debtor. When American confidence breaks, the reversal will be sharp. Not Japan's slow deflation, but rapid reversion. The combination of extreme valuations, unprecedented debt, exhausted policy tools, and psychological certainty suggests not stagnation, but explosion. The trigger won't be obvious until afterward. Maybe commercial real estate finally collapses. Maybe China stops buying treasuries. Maybe inflation returns, forcing rate increases. Maybe it's something nobody's watching. The cause matters less than the psychology. When confidence breaks, it breaks completely. The global dimension adds complexity Japan didn't face. The dollar's reserve status means American collapse would trigger worldwide crisis. Supply chains more integrated than in 1989 would shatter. Financial contagion, in a world of instant digital transfers, would spread in hours, not months. The very advantages that made America central to global finance become transmission mechanisms for collapse. Consider the interconnectedness. American pension funds own European debt. European banks own American mortgage securities. Asian corporations depend on dollar funding. Middle Eastern sovereign funds hold American tech stocks. When one domino falls, they all fall. Japan's crisis was largely contained to Japan. America's crisis would be everybody's crisis. The world has no firewall against American financial collapse. Japan's disaster wasn't inevitable. It resulted from specific choices: flooding the system with liquidity, allowing speculation, denying problems, protecting institutions over people. Every choice America makes now. The saddest part is we watched it happen. We studied Japan's failure. We wrote papers about their mistakes. We created models showing what not to do. Then we did it anyway, convinced that American exceptionalism would produce different results. The pattern that destroyed Spain's empire, Britain's empire, Rome's empire is playing out again. Excessive liquidity creates unsustainable valuations. Overconfidence prevents recognition. Institutional denial delays response. By the time reality intrudes, damage is permanent. Japan thought they were writing new economic rules. They were just repeating old mistakes. America thinks technology and Federal Reserve sophistication provide immunity. We're about to learn that financial gravity is universal. When historians write about America's bubble, they'll marvel at the warnings ignored, the precedents dismissed, the reality denied. They'll wonder how we couldn't see what was obvious, the same way we wonder about Japan. The difference between 1989 and 2025 isn't that patterns changed. It's that consequences accelerate. Japan got 3 lost decades. America might not get 3 years. The math is clear, the precedent established, the psychology identical. The only question is timing. When the Nikkei peaked at 38,915, nobody imagined it would take 35 years to recover. When American markets peak, nobody will imagine the aftermath either. That's not pessimism, that's the pattern. And patterns, unlike markets, never lie. The final irony is that both nations had the same blind spot, believing that financial engineering could replace economic fundamentals. Japan thought cross-shareholdings and government guidance could suspend market forces. America thinks Federal Reserve intervention and financial innovation can do the same. Both confused temporary suspension of consequences with permanent exemption from them. Gravity always wins. The only variable is how far you fall before you remember it exists. The real tragedy isn't that we're repeating Japan's mistakes. It's that we're repeating them faster, larger, and with less room for error. Japan had high savings, low debt, and social cohesion to cushion the fall. America has no savings, massive debt, and social fracture. Japan's lost decades were painful but survivable. America's reckoning might not offer that luxury. When you've leveraged everything, borrowed from everyone, and convinced yourself you're immune to history, the landing isn't just hard, it's fatal.